Introduction. In this course, we will discuss the first thing, that is, what is financial ratio, types of ratios, and data for financial ratios. Then we will discuss financial statement analysis. Example, balance sheet, from where you will take the numbers to be added into the formula of financial ratios to get the answer. It's really simple. You just need to get the data from the balance sheet or asset and liabilities, statement of cash flows, or statements of stockholders' equity, earning per share financial statement, and statements of operations, and just divide it by another number according to the financial ratio and get the answer, and think like a financial analyst. Because usually what the financial analysts do, they basically research the company, find financial ratios, and put their research according to financial ratios and other research, technical or fundamental. And financial ratios is the cornerstone of financial analysis. Then we discussed different abbreviations. The first ratios that we discussed was profitability ratios. In it, we discussed gross margin ratios, operating margin ratios, profit margin, ROA, that is return on assets, ROC, that is return on capital, ROE, that is return on equity. Then we discussed RONA, that is return on assets, ROCE, that is return on capital employed, CFROI, that is cash flow return on investment, net gearing ratio, and basic earning power ratio, risk adjusted return on capital for banks, and efficiency ratio. Then we discussed liquidity ratios, that is liquidity ratio overview, working capital ratio, quick ratio, operating cash flow ratio. Then we discussed efficiency ratio. Example, efficiency ratio overview, debitor collection period ratio, degree of operating leverage, that is DOL ratio, days sales outstanding, that is DSO ratio, assets turnover, and inventory turnover ratio. Now these are really important because they will tell you how efficient a company is. Then we discussed receivable turnover ratio, other good inventory ratios, and cash conversion cycle. These are really important because they tell you how much efficient the company is in getting their debts paid or receiving the money that they have given in credit. Valuation ratios will be discussed later, in which we will discuss cash flow ratio, price to book ratio, price to sales ratio, and PEG ratio. Then we discussed leveraging ratio, that is debt ratio leveraging ratio, debt ratio, debt to equity ratio, times interest earned, and debt service coverage ratio. This is really helpful because they will tell you about the health of the company, if they can pay off their debt or not. In another valuation ratio, we discussed market ratio overview, EPS, dividend payout ratio, dividend cover, and price to earning ratio with dividend yield. And then we move to bonus lectures, in which you can find my discounted courses. Thank you.